We're also taking a look at the MPC meeting outcome, but we're holding it down a bit to understanding those meetings, those policies, and how it impacts businesses in Nigeria. But in case you're not aware, maybe you still don't know what happened at the MPC meeting, let's give you a bit of a summary of the situation. Now, the meeting convened between May 19th and 2025. That was Monday and Tuesday this week. For its 300th meeting, the committee unanimously decided to retain key monetary policy parameters, which is the monetary policy rate held steady at 27.5%, the cash reserve ratio maintained at 50% for deposit money banks and 16% for merchant banks. Now, the decision aligns with the CBN's ongoing strategy to combat inflation and stabilize the naira, reflecting a commitment to orthodox monetary policies under Governor Olayemi Cardoso's leadership. Now, what are the implications for the business and the economies? Access to credit, foreign exchange stability, inflation control, investor confidence. Now, to discuss more on this with me is joining me virtually from here in Abuja is Dr. Samson Simon. He's an economist and the CEO ARKK Economics and Data Limited. Good morning. Thank you for joining us on the program this morning.
Thank you for having me.
All right. So, first of all, can you explain to us the CBN policies and its impact on businesses and what this MPC outcome really means for the Nigerian economy and the SMEs, who are the major part of our economy as well? Dr. Samson, can you hear us? All right, so while we're waiting for Dr. Samson to join us back again, Dr. Ali Elias is joining us, an economist and development expert. So Dr. Samson has joined us back again. Doctor, you can go ahead.
All right. Can you repeat the question? I didn't hear it.
So I said, could you tell us the implications, the meanings of the outcome of the MPC meeting and its impact and effect on the Nigerian economy and on SMEs, which make a major part of our economy?
All right. The Central Bank Monetary Policy Committee met on Monday and on Tuesday. And as most of us forecast, they held all the parameters steady. The monetary policy rate, which is the anchor rate, was retained as 27.5%. The cash reserve ratio maintained at 50%. The liquidity ratio held steady at 30%. And before I forget, the asymmetric corridor around the MPC is still plus 500 and minus 100 basis points.
Yeah.
Yes. And for the cash reserve ratio for merchant bank at 16%. So these are the basic parameters, and they're all held steady in their main meeting, just like they did when they had the last meeting. This is the second meeting this year, right? And the last two meetings, the one that just held now and the first one in the first quarter of this year, are the exceptions in the sense that in the last 20 months, they have held 8 MPC's Monetary Policy Committee meetings, and 6 out of the 8, they hiked interest rates consistently to the extent that they increased it by 875 basis points, which is arguably one of the longest run and the greatest hikes that we've seen in recent times. And the implication of the high interest rates, 27.5, is that the cost of credit would be there, not only for businesses in general, but particularly for small businesses, for SMEs, because they're not really blue chip companies, so they don't get prime lending rates. So the rate of interest they normally get, the best is around 35 to 40%. And with this maintenance of the monetary policy rate, they should expect more of the same, and likely even a sub-pedal, because by holding, the central bank is indirectly easing, in the sense that You were hiking aggressively. It was quite a hawkish stance. And now you're maintaining. So it shows that you're beginning to sort of pedal. So commercial banks may read the room and even give some concessions to SMEs. And these concessions will mean the cost of credit might be a little bit better, or at worst, it will be more of the same since last year. So SMEs are really struggling, and high interest rates are not really good for them. They are not good for businesses. They are not good for their expansion, and it limits their ability to borrow. And when they cannot borrow, they tend to struggle. But the thing is that it's a balancing act. The central bank hiking interest rates is trying to protect purchasing power. And if purchasing power is not protected, that also harms small businesses. So, whichever side that is taken, I think small businesses should just, as much as possible, try to look at on the bright side of things. So, if the inflation is extremely high, majority of consumers are priced out, SMEs will struggle to sell whatever they're producing, and that's also a limitation for them. And when interest rates are also high, is also a problem. So I think they should look at the bright side, because central bank is trying to protect the purchasing power of Nigerians, and by trying to tame inflation, that would be good for small businesses eventually. And then for the cash reserve ratio, you're sterilizing 50% of whatever deposit that is in a bank or in the banks in Nigeria. So that limits the capacity of banks to lend. If you're asking them to keep 50% of whatever depositors are keeping with them with the central bank, and it's sterile in the sense that it doesn't attract any interest. It's not like the standing lending or standing deposit facility that some interest has been attached. So it limits the capacity of banks to lend to small businesses and businesses in general. And that means less credit for businesses. And when they have less credit, that also hampers their expansion. And that means they will also struggle to pay up, just like the interest rates. And for the liquidity ratio also, the 30%, it means 30% of whatever is deposited with banks should be in liquid form for depositors that want to access any moment that they want to. So it also limits the capacity of banks to lend to businesses. So generally, if you look at it, we are having a tight monetary policy, in the sense that virtually everything is being sterilized. It limits the capacity of the banks to lend to businesses, and when businesses cannot access credit, that limits the ability to get things done. And also, the high interest rate means anybody that is borrowing has to look at the rate of return. Nobody wants to borrow in a high interest rate environment, because what are you expecting to get in return? Will it be higher than this high interest rate? If it's higher than the high interest rate, then it makes sense. But if what you're expecting is somewhere in the region of the high interest rate, then it doesn't make sense for you to borrow. So people will struggle, small businesses in particular will really think twice before borrowing from banks.
Okay, so now we see that some people have come out to say that they're not very comfortable and they don't know that something needs to be done. We see NECA said that yesterday in a statement, Dr. Yerinde saying that the Monetary Policy Committee, they're concerned with the continued reliance on monetary policy tightening. The LCCI, Lagos Chamber of Commerce, had something to say about it too. The private sector said something about it too. They're asking these people to find a way to reduce this rate. What's your take on that? Are you in support of that notion?
Like I mentioned earlier, is a balancing act. If I were in the position of the central bank governor, I think I would have done exactly what he did, or what the central bank did. Because the overarching mandate of the central bank, mind you, is price stability. Any other thing is secondary. And achieving price stability is not a painless policy. There will be pains. And some people, sadly, or some businesses, sadly, will be thrown under the bus because they are struggling to access credit, and you're hiking the rate of interest, or even if you're maintaining high interest rate because you're already in a high interest rate environment. Mind you, our Uncle rate is one of the highest in the world. And for our cash reserve ratio, is even the worst in the entire world. So it's very tight, and they are maintaining the same thing. What is the result to trap for the existence of the central bank is price stability. Any other thing has to take backseat to price stability, and that's what they're trying to do. And some people say, all right, but even the price stability has not largely been achieved. Even the inflation we're seeing, the 23.71, is largely due to the change in the methodology of the CPI, which is the key metric they use for prices. But they are doing their best, they're doing their bit. And if you look at it, there are other aspects. We have some wins too. Our foreign exchange results, we have seen accretion. Our exchange rate is largely stable. So it's a balancing act, and it's not a thing that they intend to maintain it forever. If prices normalize, if inflation is largely within target, they will subpedal, they will cut interest rates, and everybody will be happy. But for now, the overarching objects is price stability, and everything is being done to achieve that price stability. And like I said, the essence, why do you want to achieve price stability, is to protect purchasing power. There are businesses that have gone under because consumers have been priced out. So don't only look at one side. One side is that the cost of trading is too high, which is understandable, it's bad. It hampers the progress of businesses when interest rates are high. But you have to look at the other side too, that purchasing power of the people, because you don't produce as a business for yourself, you produce to sell. So if consumers cannot buy, then what is the essence of producing? And you have them stocked up in your store. It doesn't make sense. So all of them are important. So it's just about priorities. And I think the central bank is setting its priorities right by trying to achieve price stability first, and then other aspects can eventually be taken care of.
Okay. All right. So let's join Dr. Aliyu Elias, is a CSA advisor, joining us virtually too from Abuja here. You've heard what Dr. Simon has said. What's your take?
Right. Thank you for having me. I largely agree with Doctor, because most of us are expecting the exact thing that CBN came out with after the MPC meeting. However, CBN is looking at a hawkish approach, which is quite challenging sometimes, because if you are sacrificing growth for to make sure you curb inflation, sometimes it has to be methodological, and you have to be very, very careful in doing that. Because if you look at the analysis they have actually put in place, yes, CBN is expected to do, but as a Nigerian, as a business person who know the challenges of or the effect of the cost of borrowing that we're experiencing now, and who also know the macroeconomic effect of that once the inflation is there, people that are actually supposed to go to bank to borrow to do business so that there will be employment, we find it difficult to actually go. And in the long run, it also slow down the economy itself. So this is the dilemma we are in, as much as we appreciate that they did not even move it 2 times consecutively now. You recall last year it was every time they keep on adjusting it. We are hoping that maybe by next MPC meeting, they'll finally look at a way of breaking it down. There are other global issues that could also discourage them from actually reducing it. If you look at the global uncertainties, you discover that if you look at a trade policy relating to Trump changing the narrative, as it were, if you also look at the oil price globally, these are factors that would discourage that. You also look at the forex. All these things would discourage the CBN from actually wanting to reduce it. But by and large, I think they should be much more proactive, and we must not over rely on monetary policy. Other fiscal policy are there that we need to look at, because if you look at it, if the monetary policy is not in tandem with fiscal policy, and the trade policy is also looking at bringing things to a better place, at least balance of payment, balance of trade to an extent, it will always be like this. So we must also work more on making sure that our fiscal policy are also balancing what monetary policy is trying to do.
All right, thank you, Dr. Ali. You've brought us to a place where I was going to go to, so I'll just get into it now. Dr. Simon, he said something about fiscal policy. Now, what role does that play alongside monetary policy in economic stabilization?
Well, there's a need for fiscal and monetary policy coordination. If they work together, they achieve that synergy and they tend to be more effective. But when the fiscal authorities are working at cross purposes with the monetary authorities, they eventually cancel out whatever they're trying to do. And if you look at the monetary side, it has been tightening, it has been hawkish, it has been embarking on contractionary monetary policy. But on the fiscal side is the other way around, it's expansionary. We are experiencing deficit budgeting, right? So they are expansionary in nature. And that's why largely the monetary policy might not have really been effective in taming money supply, because despite the hawkish stance that we saw throughout last year, money supply was reaching unprecedented levels. And that was largely contributed to the high inflation that we saw last year, and we're still seeing. I know the methodology has changed, so inflation has not really come down. It's just the method that has been changed, the base year, the components, and so on. So it's not like prices are down, it's just a new method. And they need to work together, they need to achieve that synergy. And like Dr. rightly mentioned, maybe there is, some people feel there is too much reliance on monetary policy. They have a point in the sense that if you look at inflation, I know inflation is largely monetary in nature, but the truth is that aspects, particularly for food, that's not within the purview of the central bank. I know the last central bank governor, the last substantive central bank governor, tried to embark on unorthodox policy by doubling into agriculture and so on. Nobody will advise the central bank to go into that. You can work with the fiscal side to achieve sufficient food supply. And mind you, food supply is a major problem. I know things seem to be easing a little bit now with the prices of some food items, but it's not yet the whole. We still have a long way to go. And that key component is very important, and that's largely the responsibility of the fiscal side. If there is enough food supply, and that will help bring down prices. But like Milton Friedman, who is arguably the greatest monetary economist, will always say, inflation is always and everywhere monetary. So we know the structural rigidities are there, they exacerbate the inflation. The monetary aspect is heavily there. And even the monetary aspect is not just the monetary authorities, like we have seen in the way the fiscal side is expansionary and the monetary side is contractionary, and money supply keeps climbing. So there's a need for them to work there is a need for them to work together to coordinate the policies. Each one should meet the other one halfway for us to have the desired results that Nigerians expect them to produce.
All right. So lastly, just before we let you go, Dr. Simon, how do these CBN policies affect foreign investments into the country?
Well, if you look at it, we tend to be doing largely okay with portfolio investment, foreign portfolio investment. And that's because of our relatively high interest rates. Because if you look at the yield on bonds and treasury bills and other instruments, it seems to be. And now that the inflation numbers have even changed, it gives you real positive output, that real positive return, that in the sense that the rate of return now, the interest rate is higher than inflation. Before it was even negative. So now we even attract more of these foreign portfolio investment. But foreign portfolio investments are hot money. They are not sustainable. They are not the best for the economy. Foreign direct investment really shows vote of confidence in the economy, in the sense that you're coming to set up a factory or you're coming to take controlling stake in a factory. So that shows long-term commitment. Foreign portfolio investment doesn't show long-term commitment. It shows that you're a bit skeptical. I know it's also a kind of vote of confidence for you to even bring your money in the first place, but it doesn't show long-term commitment right? So, and we're not doing really well when it comes to foreign direct investment. So we need to find out where the issues are to attract this foreign direct investment. And sadly, we're not even failing to attract foreign direct investment. Even some of them that we have are exiting the Nigerian market, which is not really good for us as an economy, because we need the foreign direct investment for growth, for employment, and for so many other positive aspects that the Nigerian economy really desires.
All right, thank you so much, Dr. Samson Simon, for joining us this morning on Business and sharing your insights on the MPC outcome. Thank you, thank you.
Thank you.
Thank you for having me.
All right, now we're still staying with us rather, is Dr. Ali Elias. You heard what he said about the foreign direct investment into the country. What's your take on that before we go to our next conversation?
Right, like he rightly said, I think we are seeing much more of portfolio investment that doesn't come with our fiscal of industry, manufacturing sector, and that's not a good one for us because it may not translate to economic growth as expected. We are looking at it at a portfolio level until we have something fiscal like industry that can create employment, that can also be with us for long time. So if it's portfolio investment, the investor can also see a business opportunity in another area in terms of stock and also move the fund. But when we have a fiscal one that can actually generate employment and in the long run increase our GDP as expected, will be the best for us. So for me, I think we should do more to attract much more real business compared to portfolio investments.
All right, thank you.